Advanced liquidity 201. Equal highs and equal lows. We already know what these are, so we're gonna fly by them, right? We already know what equal highs, equal lows are. So let's think about it. What do retail traders see? We know that retail traders obviously see support and resistance. Support and resistance, when you're looking at equal highs, equal lows, it's just a conglomerate area that has at least two touches, but if not three. These touches, it doesn't matter if it's candles, bodies, so on and so forth. But what is essential is it's building some form of ceiling. It's building some form of resistance where we know traders are going to be selling at. So if traders are looking to sell, we know where their stop losses are and vice versa. If we know that we see, oh, here's one touch, two touch, three touch, four, we know that looks to appear to be some form of price floor. So this is where retail traders are going to expect to sell from, expect to buy from, right? So why do retail traders use this? Because it makes sense to sell and buy at areas that have previous rejection. This indicates some form of threshold that's going to allow the market to reverse. Now, if you don't have a stop loss, you might get lucky, but other times you're going to be completely screwed. That's why equal highs, equal lows are the most basic form of retail liquidity, but just a very small piece. What market conditions do they occur in? Support and resistance primarily occur in ranging conditions, as traders are typically trading zone from zone. I, for one, know that when I first started with price action, I was trading zone to zone, whatever made sense, because that made sense. So you're going to see support resistance all over the place. We spent too much time on it because you guys already have that understanding. So now equal highs and equal lows, right? We know that these traders, they do not have their stop losses exactly at these areas. They could be 5 to 10 pips afterwards. So the purpose of these types of liquidity is to build a pool by accumulating buyers at support and having those sellers distributed at resistance who got in prematurely. Again, everyone who's looking to sell here, they sell these rejections, they're going to be entering after that. And the more times that you see a specific level rejected, you need to think about the purpose behind that is the more times that people are trying to sell and price is building a huge resistance, you need to think about, damn, there's a shit ton of money that's lying after where they're looking to sell, because the more touches that you have, the more rejection indicates the more amount of sellers who are trying to sell the market, which means the more amount of sellers, in terms of money, a much more amount of stop losses are lying above. So what happens is after there's a ton of sells, stacked, price liquidates them, and then based on the amount of liquidity that's building, you can expect a huge move in the opposite direction. But you can understand how large the move that will happen based on how much liquidity is building before the move. If it's just two highs like this and price were to wick it out and drop, it's not going to be as expansive because there's not a lot of stop losses lying above those two highs. There only might be a couple, relatively speaking. So now from a liquidity perspective, what do we look to do? We look to sell above resistance and buy below support. Knowing that retail is going to be looking to sell here, we need to be looking to sell above. And if we want to sell above, what's going to actually cause price to reverse? Two factors. And this is important to do, so I say this all the time. There's always two things that need to happen in order for price to go anywhere. Enough gas needs to be collected, and two, there needs to be a strong enough order block that will cause price to get to its destination. So in this instance, we know where all the gas is, it's above here. Where's the stop, or where's the order block? The order block's going to lie after our highs, so we're going to want to look above over here. So that's going to be our order block that we're going to use after liquidity is taken for us to sell all the way lower. So it becomes very simple. Where's the gas? Where's everyone losing? Where they have their stop losses? Then identify the order block that lies above their stop losses, enter on that order block, and then price obviously will liquidate in the other direction. We get in where they get stopped out, right? You have retail who buys low, sells high. You have S&C who buys lower, sells higher. You then have institutions, algo, we buy lowest, we sell highest. Within the course, the expected outcome in this scenario, sellers get taken out before price sells off. Sellers get taken out before price sells off, and buyers, they buy before price goes in the opposite direction. Always going to be the same, right? So the initial application of this concept. Determine the trend. So everyone, I want you guys to take 10 seconds and tell me based off your knowledge, not about structured BOS, what does the trend appear to be like? Are we in an uptrend, downtrend? Everyone just either draw the chart or type in the chat, up or down. All right, so we're in a downtrend very clear, right? So we're in a downtrend, all right? So after we're in a downtrend, great, we know that we're looking to sell. Next thing we need to do, if we're looking to sell, we need to ask ourselves, where's the liquidity? If we're in a downtrend, what type, do we look for equal highs or do we look for equal lows if we're looking to sell? Right, so if we're looking to sell, we look for equal highs. Where are all the equal highs? Everyone, again, engaging, everyone participate, analyze. And we're forecasting the move. Remember, this move has not yet happened. You're going to be forecasting it. So everyone annotate on the screen. We can clearly see here, we have our equal highs right here, very evident. We have one touch, two touch, three touch. All of this is acting as a resistance, right? Next thing that we do is we then anticipate an order block, right? We anticipate an order block. So we know that we have all these equal highs right here. We see all over here. We have one touch, two touch, all of these relative pool. This is going to be used as some form of support here. We have our resistance here. Now we need to ask ourselves, we want to sell lower. Where's the gas? It's above our equal highs. So now where is the order block? Everyone go ahead and identify the order block. All right, so then let's see what happens, right? Our equal highs right here. This is our order block right here. For those who said over here, remember about order blocks. This one, yes, this was an order block, but what happened? It was already mitigated. Once an order block becomes mitigated, it doesn't become relevant anymore, right? And this at a service level, it doesn't become relevant. We only want an order block to be mitigated once. For those current students who know, there's a reason why it can be mitigated twice, but we don't have any information on that right now, right? So this is the only order block. And why is it this? Because over here we had an imbalance, but the imbalance was filled. It was mitigated. Perfect. So that's now taken care of. We know that this order block is not valid. We got to look above here. So where's the next order block with imbalance? We have a little gap right here. We have our imbalance. We then have our order block. So this becomes our valid order block. Now everyone go ahead and anticipate logically what the new move is going to be. Boom, right? And so that combining everything that we just talked about, exactly. In order for us to get to our destination, which is down here, we need gas to get there. Where is going to be the gas if we're in a downtrend? Our gas is going to be above highs. So this is the gas that we need to collect at the gas station. This is then going to be the order block that's going to cause price to go lower. And then this is going to be the new destination that we're targeting because we want to be targeting new liquidity. We're going to be targeting new lows. So take out a high to then take out a low. And that's how we are going to be looking to sell. And exactly as such, right? Let's go to another one. Why is this not? Hold on, y'all. That's what some issues we had this morning, things were not copying correctly. All right, so the first things first is if I were to do this, well, I'll just walk you through. In this case, right, I don't know why this was inverted, but we can see here, based on this, the first thing I want to do is determine the trend. In this scenario, all of this to the right over here was hidden. This is all hidden to the right. Now we can see that all of this is hidden. The first thing to determine the trend, well, based off this, we can tell we're kind of going bullish, right? So after we identify that bullish trend, we then want to ask ourselves, right, exactly, if this is where we want to make new highs, right, if that's going to be our destination, where's the gas? The gas is going to be below our equal lows. Again, we have one low, we have two low, three low, four. Someone's looking at this as a support. So then we look to buy below this low. And where's the order block? The first order block with imbalance right below. We can clearly see right here, right? This imbalance was filled. This is our only imbalance right here, right here. This is our order block. So this is our destination. This is going to be the gas that's needed to get to our destination. So gas is going to be collected. And then we know price is going to go higher. Why? Because our destination lies at equal highs, very clear resistance that everyone's going to be looking to sell it over here. So now we're starting to develop not just the understanding of liquidity, but how price is actually going to move to get there. Always logical. Of course, then it'll just end up going all the way there. So in this example, we're gonna do one more, go on to the next one. Everyone go ahead and identify in this case, determine the trend. What is the trend? All right, everyone's saying buys, right? Awesome, yes, so we are bullish. Great, we're bullish. After we identify the trend, next thing, what's the next thing we identify? We are in a bullish trend. Where do we look to buy below? Beautiful, so one at a time, right? Great, now we know where we're gonna be buying below. Awesome, right? Now we have what we're buying below. And the last thing we need to identify is what? If we know we're going to go higher, we have our liquidity. Where's our order block? Boom, right? This is our order block. Where's the first imbalance below? Our first imbalance below is where? Well, this imbalance is already taken care of, right? Where's the next gap? Boom, next gap's right here. This is our order block. And remember from the video, it takes out, order blocks must take out liquidity. This order block takes out a previous wick, indicating money has been efficiently swept. And this is where the orders are still placed. This is our valid order block, right? So this is our order block. Now, how do we anticipate price getting to the gas station and to then go to our destination? What are we going to anticipate? Beautiful, right? Starting to really build purpose for moves, not just it's going to go here. How's it going to move to get there? So exactly that, right? All equal highs over here. Here's our equal lows. We're going to have to take out gas from above a high to then get to a low and then a target, right? New highs. Boom, very quick. This is just how the principle of liquidity works at initial application. Even equal highs, equal lows, we already know this, but we're transitioning to not structure-based trading, but liquidity-based trading, right? So this is very simple. Identify the trend line. Are we going higher or lower? Higher, buy below equal lows, order block below to then target new equal highs, right?